Hello, I'm Seth Block, Executive Vice President of ThermoCredit and the host of the Funding University podcast. I want to thank you all for joining us at our latest panel discussion of the Funding Strategies Conference. We've been hosting these panels for about a year now, and the feedback has just been incredible. I am absolutely thrilled and honored to know that our conversations have helped so many businesses make informed choices. I hope you will find today's conversation just as valuable as our previous sessions. I'm very excited to welcome our panelists and guests joining us today, as well as give a hearty thank you to our sponsors, Channel Vision Magazine, Remote Work Solutions, the Funding University, and ThermoCredit. Now, I'd like to introduce our moderator, Paul Stamoulis. Paul's successful background is in growing, financing, and selling technology companies with net tech services such as internet, cloud, voice, data, and managed IT. He brings a wealth of business knowledge to the panel. Paul is currently a senior consultant at One Stop Capital. One of the primary goals of the Funding University is to help educate business leaders about smart and objective funding choices. An informed leadership team can better anticipate market trends, leverage assets for growth, and prepare for the days to come. So I'm especially excited to be able to assemble this group of experts to share their knowledge with you today. With that being said, I'm going to hand it over to Paul so we can get started.
Well, thank you, Seth, and hi, everyone. As Seth said, I am Paul Stamoulis, Senior Consultant at One Stop Capital. And welcome to this edition of Funding Strategies Conference, where we'll talk about interest rates and the real cost of doing business. Today's webinar will focus on interest rates, the pros and cons of fluctuating rates, and talking about how rate changes can affect your bottom line. We're excited to share our opinions about the latest trends and strategies as you can better manage debt and increase your profits. I want to welcome our esteemed panel of experts who bring real-world experience from banking, the SBA program, alternative lending, and venture capital. And first, we have Antonio Estrada, Chief Financial Officer at Digerati Technologies. Antonio serves in the public company and telecom industry, and he has vast experience and expertise in SEC reporting, accounting management, financial reporting, forecasting, strategic planning, corporate finance, audit, and treasury and cash management. Did I miss anything, Antonio? That's quite a long list.
I think you covered everything. Yes, you did.
So next, please welcome Jen Merritt. She's the president of Haversine Funding and an expert in commercial finance and is responsible for originating, underwriting, investment analysis and management, and asset allocation strategy. Jen serves on the factoring committee for the Secured Finance Network, or SFNet, and has helped develop the first factoring certification program for the industry, which was sorely needed, I bet. Our third panelist is Milton Iskra, who is the managing partner and capital market specialist for Spark Binder Capital. Highly skilled and respected for his experience with asset-based lending, Milton is an expert in financial advisory, financial analysis, and finance consulting. He also has a top-notch understanding of asset-based loans. And last but not least is Micah Adams, Vice President of Panos Partners, a private equity firm. Micah has experience in capital markets, corporate finance, with a focus on assessing growth initiatives. Micah focuses on structuring financial transactions to produce value for portfolio companies and targeted returns for his investors. And thank you, everyone, for being here. And let's get started, shall we? All right. So first, I guess our first question is, how do changing interest rates impact the financial health of small businesses? And I know this is an obvious question, but we're going to start with Antonio to have him give us some of his insights. Antonio.
Thank you. So, based on my experience, at the micro level, the increase in interest rates, at least from what we've seen for small businesses, it becomes a significant burden to continue to grow. And it also limits the cash flow of the company. So it basically forces small businesses to postpone large projects, new equipment purchases, even in some cases, even reducing your marketing budget. And also, in our case, also postponing key hires. So it has a significant impact on the small businesses.
Right. So it has a lot to do with the cash flow of a small business. Anyone else have anything to add with this? And if not, we'll just go on to our question number 2, which is how can a small business owner manage interest rate risk? Anybody want to take this on? Volunteers? No, I guess
Sure.
that's a tough one.
Sure. Small business owners can manage the interest rate risk that comes with the different debt or lines of credit or term loans, leases, et cetera, they have out there through getting fixed rates. So getting a set rate on the debt as they're pulling it down or enter into their credit arrangements, along with variable rates that they could have that are tied to things such as prime, LIBOR, SOFR that we're using now, and how those rates change over time as those index rates change. And so they can, just to summarize, can either enter into fixed rate agreements that are stated as part of the debt that they're taking on, or variable rates that are tied to indexes out there.
So what you're saying, Mike, is the business owner needs to stay abreast of what's happening to various indexes and plan accordingly for what may happen to him.
That's right. And pay attention to the talking heads, as I like to say, are out there talking about the interest rate environment, what the Fed is doing, and are rates increasing or decreasing, along with what people are anticipating in the future. I mean, there are more complex financial instruments, such as interest rate swaps, that businesses can enter into, but I imagine those would be cost prohibitive for small businesses.
Okay. Well, thank you for that. So our next question has to do with changes in interest rates and how these changes affect the borrowing capacity of a small business. Who would like to take this on, Antonio?
Yeah, so, in our case, as a small business, the increase in interest rates, it limits the ability to secure finance that will allow you to grow through expansion. The higher the interest rate, the more difficult it becomes to service the debt, in addition to, impacting your bottom line. So it becomes a huge challenge for small businesses.
Right.
I think,
Okay, well, that makes sense. And what role do the interest rates, which leads us into our next question, what role do interest rates play in a business owner's decision to invest in inventory, equipment, or property? I mean, the obvious one here is as interest rates rise, it makes things more expensive. But Jen, Milton, maybe, or Jen, I'm sorry, maybe you'd like to answer this one.
Yeah, I think, and I'm sure Mill has additional feedback on this one too, but I think it kind of depends on where they are in their business cycle. If they have new opportunities that they're seeing where paying more will actually help them take new contracts, get new customers, things like that. So I think where they are makes a difference. And I think it depends on, how the company's performing. As Antonio said, cash can be tight now and you have to make different decisions. But if they're managing their margins and passing things through when their costs are going up, that kind of weighs into their equation for that. It's kind of the same philosophy, whether it's inventory, what their margins are, what that higher cost, what that analysis looks like for them. And then real estate, honestly, I think that just depends, because it's not just about that cost. It's also going to be about what kind of debt did they take on for that? I think Micah mentioned, different kinds of debt. So if they took on bank loans for that real estate, what are their covenants that they agreed to? Because over the last year, several business owners have ended up defaulting on their real estate loans because they didn't take those covenants into that equation. Milt, did you want to add anything else?
yeah, I think that basically one of the challenges is in the small And once again, we really haven't defined what small business could be, but they have less options when it comes to protecting themselves. And I think more recently with the companies that I've worked with, they've been challenged because their interest rates interest rates went from 0 to 4% on base rates, in the marketplace. And so you can imagine what's happened to a lot of these times. And without getting too far in the weeds, I think the decisions are going to be probably a cost benefit analysis. Are they going to put in a machine that's going to produce, products at X% that justifies the investment? But the interest rates obviously are going to be the final tell on that. So,
and Milton, just as an add-on, you talked a little bit about the benefits of low interest rates. How about some drawbacks of low interest rates for a small business? Are there drawbacks?
Yeah, there have been. I think they've been taking effect over the last. Well, we've had artificially low interest rates since about 2009, and from what I've seen, both as a lender and then subsequently as an intermediary, I've seen a lot of businesses, small businesses, who have utilized the lower interest rates to expand their market share by lowering prices and gaining market share. The unfortunate thing is when interest rates rise, and they tend not to have the pricing power to pass that along, and we've seen margin squeeze. So it giveth and it taketh away depending on what part of the cycle you're in. But currently it's going against the company, not for.
Okay. All right. And how about the inverse of all this? What about, are there benefits with high interest rates for a small business, Jen?
Weirdly, yes. Although no one really likes that. They like the lower interest rates. I think as rates go up, there are some market shakeouts where, prices that have been inflated start coming down and getting more normalized. So no one likes that, but I'll pick on real estate again. Over time, as rates go up, then the prices for that product are going down. So it kind of evens things out after having a low interest rate period. It's also a good time for owners to look at, are there other places to put the cash that they do have available into money earning investments, whether that's, looking at your bank account, how much are there other vehicles or other accounts that you can talk to your lender about, or others that you talk to about those things, on how to make money on the cash that you do have that you're sitting on. And then some would tell you that this is a really good time to have that cash available, so that when an opportunity comes up, because others won't be able to sustain their businesses with high rate environments. So it might be a good opportunity this year, as those rates continue to increase, to look for, acquisitions and other things like that. Yes, they're more expensive, but at the same time, there's opportunities that would not otherwise come out, out of the woodwork if it weren't for the high rates that are going on right now.
Okay.
Again, still prefer the low rates, but.
Well, thank you for that. Anybody want to add anything to that?
Yeah, I recently have worked through a process with a company, and it's not just because of the high rates, but they're not something that you have control over, and you may not be able to pass them along. But what we did is we took the company, they had two separate entities. There was really not a good reason to have that. We basically put those two companies together. We physically put together the two locations and cut about $2 million out of the OPEX. And I guess what I'm saying is that high interest rates can cause you to take other actions within your companies that are beneficial. It's not really a benefit of a high rate, except it forces a different behavior.
Okay, right, understood. And how about in an environment where a business is leasing equipment? What's the impact of high interest rates, or how do interest rates impact the cost of leasing? Who wants to take that on? Anyone?
Well, in leasing, I mean, your cost of funds is going to affect your leasing factors, and so the leasing, basically the leasing price is going to have the same, depending on, without getting into the tax benefits and stuff, if it's a true lease versus a finance lease and that type of thing. But it's still going to be the cost benefit analysis of the machine, I think, to
So not a whole lot of difference between leasing and lending. Similar.
well, yeah, I don't want to be that generous, but it's there's still going to be, leasing takes financing as part of the transaction.
Mhm. All right. And what about the other side of the equation from a small business side? How do interest rates impact the cost of servicing that existing debt? Antonio, you want to try that one?
So in our situation, higher interest rates put you in a situation where you're having to pay larger cash payments, right? And so I think Milton mentioned this before. It kind of forces you to be creative in a lot of different ways. You identify other cost savings that could actually help you offset the increase in interest rates, but it also gives you an opportunity to which you can actually approach your lender and ask for flexibility, right? We've seen it in our case, for example, in which our lender has been in a position to not reduce the interest, but allow us to take into consideration the increase in interest to be deferred. So it's one of those things. It does force you to be more creative, but it also gives you maybe an opportunity to where the impact might not be as severe, but it also allows you to have more significant impact on the bottom line.
Well, thank you for that. And how about the business credit rating? Is there an impact? Can an interest rate affect the credit rating of a company? Anybody want to take that on? Milton?
I'll try that one. I mean, I wouldn't say it's a higher rate means you're going to impact your credit directly, but I mean, the higher rate means there's other things that business owners need to focus on, right? So whether that's paying their bills and maximizing their trade credit payables more, that will affect their credit. So it's really just the overall cost of the business is going up. They don't have as much cash. And so you're looking for other ways and places to make sure you keep everything together, pay your bills, whether it's stretching payables or other activities that will impact your credit score.
Yeah,
Okay.
I think that when you're looking at credit ratings, especially in the small business area, it's not so much as when you're looking at ratings on larger companies that use a specific rating system. But I mean, you'd have to define: do you have what does a company look like? Does it have a strong net worth? And does it is it or is it just the opposite with a deficit net worth, and all of a sudden the increased interest costs have caused it to be have a service ratio of less than 1-to-1? Yeah, all those things would tend to affect their ability to get further credit.
So, Milton, how about in different industries? Is there a significant difference between one industry and another, and how interest rates impact the profitability of a small business in these different industries?
Yeah, you have. I mean, in the service sector, you're going to have a whole different requirements than if you're in a high capital intensive business like the lumber business or the manufacturing business, where you have significant fixed costs and need for capital expenditures and new purchases and that type of thing, and possibly the lack of fixed rate debt, depending on the circumstances of the company. That's going to have a lot more impact than it would be if it's just a matter of a distributor, or then it's a company. What are they selling? How fast is that inventory turning? And if you have a company that's selling aircraft parts, where the turn time is maybe 360 days on average, and receivables may turn quickly, or you have a company that's selling consumer products through Amazon, and the inventory is turning, normal amount of times per year, and it's all credit card sales. So it's the working capital cycle is much shorter. I think it's probably the working capital cycle first, and then the amount of fixed charge because of more capital intensive industries. Probably more than I needed to say, but that's my thoughts.
Okay. Well, thank you for that. So that's organic, the effect of interest rates in an organic business. Now, Micah, how about in an inorganic company growth plan, where how do interest rates affect the ability of a small business to pursue M&A or some type of a combination with other companies?
Sure. Yeah. So whenever putting together your sources of capital for the different M&A opportunities that you're looking at, and evaluating the cost of capital associated with that and where the proceeds will come from, something to definitely take into consideration is using leverage or using debt to make the acquisition, and the interest rates that would come along with that, or the interest rate environment, can help to determine if that M&A opportunity is viable, both for you as a company and then also for the lender or lenders that you're looking to partner with, and the types of lenders that you're looking to partner with, and the amount of risk that they want to take. The primary driver being on that is, goes without saying, but as we said, the higher the interest rates, the higher your debt service will be, and not all projects can support that or meet hurdle rates or opportunity cost or cost of capital requirements needed to do the transaction. And on the flip side, if interest rates do increase, it can provide for a positive environment for companies that do have viable sources of capital at a reasonable cost of capital, because their competitors might not have that same option. And so they can go out to market and look for the opportunities in the companies to partner with and or acquire. And at the same time, take into consideration the debt service and the longevity of the debt service that you have, the fixed rates or variable rates.
Okay. Well, thank you for that. Antonio, you want to take that one on?
Yeah, just to add to what Micah said, I think one of the things that we've seen, the higher the interest rates is, like we mentioned before, the small business is going to be impacted, right? But one thing that we've seen is, at least from my perspective, has been that a small business that we were looking and contemplating to acquire historically, now they seem to be more enticed to sell their position in their business because they might not be in a position to continue servicing their own debt. So it allows for the opportunity for acquisitions or targets to be more willing and inclined to sell in their business. So it also, as a buyer, it gives you, I think, it also an advantage to secure better terms when it comes to securing that asset.
Mm-hmm. Okay. That's a nice perspective. Jen, would you like to add anything to that?
The only thing I would add is that it just kind of goes back to there's opportunities in this kind of environment. And so there's probably going to be more activity, just maybe not at the valuations and rates of the past, or how much people are expecting to get for their businesses in this kind of environment. So investors, I think, going forward, or at least right now, want more bang for their buck, and lack of a better term to say that. So I think they're going to focus on the future performance. And you can't really look at the last couple of years because it was a low rate environment. Things were better. And so I think there's going to be more focus on the future of the companies that they're looking at acquiring.
Milton, anything?
Yeah, there's, from what I've seen in the M&A side of things, there has been, I'll call it selective because it's not across the board, lowering of multiples going in the marketplace. I do more capital than I do selling companies, and but the colleagues I have in that space are finding the multiples have sometimes come down significantly because of obviously the ability to service the debt, and then the requirement for more equity. The equity players can't get the kinds of returns they need. Either the multiple, of the cash return on invested capital, or just the IRRs that they require. So I guess it's the two-edged sword. It drives things down. It still doesn't make things easy.
Okay. And by that same token, do the interest rates also impact the ability of a small business to attract investment capital? We just talked about a small business perhaps combining with another company or being acquired by another company, but how do interest rates impact a small business in attracting investment capital? Is it more or less the same, Micah?
I think Milton was summarizing it well there at the end about investors and multiples and returns, IRRs, and so forth that are needed. And so as investors, always looking at the universe of options that you have out there and comparing that to fixed rates, fixed income, and equity, and looking at what type of returns you might need or want in the current environment. And as interest rates go up, it does make it more, where there is more competition, so to speak, and that there are other options that the company and the investor must choose. And so again, back to the topic, the interest rates can really impact if it's a fit for the different pockets of investment capital that you're looking to raise, either on the equity or debt side as well.
Okay. Milton, would you like to add anything to that?
I agree that was a good summary. I'm seeing that a lot of these things are interest rate plays into it, into the ultimate, end result on these transactions. But the fact is that the transactions, I think, tend to get bought. There's probably more strategic deals going. A strategic isn't going to be concerned about the interest rate environment because he's probably going to pay cash. If this is an add-on to a existing business, interest rate environment, obviously the benefit has to exceed whatever that additional costs are. But there are some areas where it's not going to affect their ability to raise capital. For a company that has a decent amount of debt trying to go out and raise new equity capital or something like that to grow themselves, that can be much more challenging, I think, or at least that's been my experience.
Okay. Well, thank you for that. And how about, again, interest rate changes? How do they impact the decision of a small owner, let's say with staffing, to hire or fire or lay off employees, I should say, instead of firing? Jen, would you like to take that one on?
Sure. And I think interest rates are part of it. I don't want to say it's only because of that, because we're also dealing with higher labor costs and things like that. But, we finance lenders that finance businesses and small and mid-sized businesses. And we're seeing as those rates go up, if they don't have the right margins in place, then, and they can't pass through costs, which we've all noted you can't always do, and that's a cost that they have to pay, right? And so it's going to affect, can they hire people or not? And what we've seen the most of so far, at least into last year, is companies are not replacing people, and they were letting them just go ahead and find a job somewhere else when the market was good for that, but they weren't replacing those positions necessarily, and doing the internal hire where they were using existing personnel to fill those roles by cross-training and things like that. And now, as companies are going through that process, we are seeing people start actually cutting positions because the rates are going to be higher, labor costs are higher, all those kind of layer together. So it just makes it a little bit more difficult. So we're starting to see the impact on small businesses starting to let people go for just higher cost of keeping everybody.
Okay, and I guess related to hiring or laying off staffing is also, how do interest rates affect an owner's decision to expand their business or reduce their business? I mean, staffing has a lot to do with that, but there are other factors as well. Micah, would you like to answer that? Or
Sure. Yeah. So when looking at the expansion projects that the business owner might have in front of it, if using debt is one of those sources of capital for this runway or for this expansion needs to invest in, needs to take into consideration the payments that will come as part of that, and the type of interest rate that it has, such as the fixed versus variable, along with the term of the loan or debt that they have pulled down. Just to touch on that, and for people newer to this audience, term on your term being how long your debt is outstanding can also very much affect what your P&I, what your principal and interest payments are, and something that needs to be considered as part of structuring a debt. But so on the expansion side, just looking at what their cost of capital might be if debt is a source for that for the runway. And then on the contraction side, if interest rates do increase, it might make the cash flows within the business a little tight and cause the business to look at contraction, or to look out and think that we could be heading into a recessionary environment with rising interest rates, either across the economy or in specific industries, which might make the business owner determine that the different expansion business opportunities that are in front of them aren't as viable as they are in a lower interest rate environment.
Okay, great. Well, thank you for that. And I guess, again, related to expanding or contracting operations, how do interest rate changes impact small business loans for inventory or equipment? Milton, I know that's sort of a similar question, but is there a difference with how you would react to that?
I would think that, once again, you have to look at the need for the CapEx. Is there a consistent revenue run rate under the existing debt load, and how by adding the new machine, which is going to be the increase in debt service at the higher capital, what's the value of that? And I think the same thing is true with inventory, or you may go to your sources and you may be negotiating heavier for pricing. You may be negotiating heavier for terms from them. So there's a number of solutions to it, but at the end of the day, it is going to have an impact on either how you're buying it or are you buying it.
So what you're saying is pretty much every part of the business is affected by this,
Yes.
whether it's staffing, inventory, organic growth, et cetera. So, and how about lines of credit? How does an interest rate change impact a small business that relies on a line of credit to do their business? Jen, can you take this on?
Yeah, I think it's the same, kind of similar to the other things. We're still, business owners have to look at all the different variables that go into the cost to make up of running their business. And I think, the last couple of years, that hasn't been it's a line item, but it hasn't been as such a focus. And so I think what's happening is, if you need to borrow and you need to use those other avenues, sorry, not other avenues, but if you need to borrow on your line, you're going to have a higher cost. And so people are looking at the other avenues, like how do they not need to do that? How do they lower their costs? And that's going to be looking at other areas of the business. We've had people cut trade shows and do other things that seems counterintuitive because, you want to grow and get your name out there, but they're really focusing on, changing their vendors out, looking for negotiation in any of the contracts they have because they're going to have to pay for the higher rate. That's just kind of the environment that we're in today. So it's just kind of a mindset shift on things that we all should be doing all the time, right? Always looking at how to negotiate and have the best deals. I think people and business owners are really focused on doing that right now.
Micah, anything to add to that?
Well, just to go back to one of the earlier questions or points that we were making about expansion and contraction, this is one of the areas that can lead to do you have the expansion or not, would be the interest rate on your line of credit, because as the interest rate goes up, you have a higher monthly debt service. As the interest rate goes down, a lower monthly debt service. And you can also look out to when the maturity of that line of credit is and how you will meet or potentially refinance that line of credit as it's approaching.
Okay, thank you. Anyone else, Milton?
Yeah, I think that all the points have been covered pretty well. Once again, it depends on the type of business it is because of the if you're selling credit, if you have if you're selling Christmas trees or Christmas goods, obviously your inventory is going to have to back up for quite a while, and you may even have dating terms on that. That's going to affect it fairly significantly. If you're, doing internet retail, it's going to turn fairly quickly. So it's and what I'm seeing, just as an aside, I'm seeing today is a lot of in the interest rates. I'm seeing this environment. I'm seeing a number of businesses who they're not being asked to leave from their current lending source, but they are being capped, which is the same as being asked to leave if you're in a dynamic business that's trying to grow, but that's my bread and butter. So,
and that was a line of credit, right? So now, how about with the variable rate loan? Is there any difference between how small businesses are impacted with a line of credit versus having a variable rate loan? Anyone like take that one on, Micah?
Sure. So in a fixed rate, or typically know what your monthly payment is, and it's amortized over the life of the loan. Could even include a portion of interest only early in, and then amortize out with principal and interest payments that are typically the same over the life of the loan. In the variable rate, it's very much tied to some type of index or rate that's out in the market, where the lender adds points or interest rate or basis points to an index, again, as I mentioned earlier, such as prime and or SOFR. And your interest rate on the debt that you have or what you've pulled down, such as a line of credit, is tied to that, and your payments change based upon that fluctuation in the interest rate. It can be, it's double-edged, can be good and can be bad. So in a rising interest rate environment, it pushes up your debt service. In a lower or steady interest rate environment, it holds your payments still or it can actually push them down, which can be helpful in making those decisions about how you run the business.
Okay. And is there anything that a small business can do to prepare for these changes? You see it on the news, you hear it on the news, interest rates are going up, meeting in September or something of that sort. Is there anything, Micah, that a business owner can do to prepare himself?
Well, I think it's good to always stay as much as you can along with running your business. So you have to fit it in as properly, but on what are the options out there for you and planning for that in the future. One of the easiest ways, so to speak, to meet that or deal with that is to enter into fixed rate agreements whenever possible, assuming that you think that you're in a rising interest rate environment. Right now, there are probably less lenders that are willing to do that, or lenders that want to adjust those rates on a regular basis, considering what we're seeing out there in the interest rate environment. And then on the other side would be to consider what other capital pools are out there beside the debt that you can use to leverage the debt as well and to put to work, in such as getting prepayment from your customers or getting longer terms from your payables, things of that nature.
Okay, makes sense. So let's now go to positive side of this. How can a small business obtain a loan with a favorable interest rates apart from something like a small business administration loan, like an SBA loan? Is there anything else that a small business owner can do so that they can lower the interest rate that's on their loan? Milton, would you mind taking that on?
Well, obviously the companies who have a low amount of debt, a large amount of equity, positive working capital, history of profitability. I'm describing a very and low leverage profitability. I'm describing a down the center of the fairway bank loan.
Right.
And that's, I don't know how a business, is where they find themselves in a particular point in time will probably determine where they are. That would be the best rate. Now, if there are some businesses, though, that don't, They don't. They may be profitable and everything else, but their bookkeeping and reporting capabilities may be extremely difficult. They're probably going to need some other alternative, and or they may need more flexibility. So you're trading low rate, low est rate, I should say, for something fairly attractive but fairly strict. For something a little bit higher rate, but maybe a little more flexible. So I don't know if I'm answering your question, but that's how I see the market in the real world.
Okay. And how about from an
Paul, I'll just Milton hit on something there that I don't know that we really touched on that I thought was a good comment. The more prepared the businesses are in the form of having good financial reporting, good financial statements, backed up reconciliations, things of that nature, can lead to them being more attractive from the lender side and help with the interest rates as they're out there looking to raise or bring on more debt capital as well.
Okay. All right. Well, thank you for that. Now, how can a small business owner negotiate a better interest rate with a lender? Say they have an existing loan, they're trying to work through it. They want to affect their payment schedule or something to do one of the terms of their loan. What's the best way to negotiate a better interest rate with a lender? Antonio, anything to say to that?
I think from my position, I think one of the things that we do prior to entering into some sort of a relation with the lender, you do your due diligence, really understand what kind of lender it is, whether or not they're going to be flexible in situations where you might require them to be more flexible. So that the initial due diligence before you enter into an agreement is key, because when you're experiencing significant interest rate increases or changes in your business, because of factors you cannot control, you want a lender that is willing or available to be more flexible to restructure the financing agreements, where they might be allowing for that increasing interest to be deferred or resetting financial covenants to allow for the business to get back on track.
Right. So if it's already part of the deal that you negotiated, then obviously take advantage of that.
No doubt. That has to be. Yeah, that's one of those things you got to kind of identify it early on. Almost kind of plan for the worst case scenario in the event that it does occur.
Right. And Jen, you want to add anything to that?
Yeah, I agree with that. I mean, it's something, again, we do when rates are low. We're not thinking about all those things, but you want to plan for that and cover all those bases before. But now that we're already here, I'm going to go back to what Milton and Micah mentioned as far as, in order to have those discussions, they're going to have to make sure they have their financials together. We look at businesses all the time that have old, outdated financial statements just because they don't have the internal groups to do that. So having those financials updated, you can't, what's that old saying? You can't manage what you can't measure. So in order to go negotiate, you have to know what you're negotiating for. And so getting your financials, keeping them updated, making, helps you with that process. And also, in order to go and ask, you can ask for a rate reduction, but I think being armed, I guess, with information and educating yourself of what programs are out there and what other banks are offering. And so making those connections before you go and do that will help, because if you just go and ask for something, then you don't know what the market is, it makes it harder. So knowing and talking to different banks, seeing what your options are, there other programs out there, understanding all of that, plus what's in the agreements you already signed. Is it just the rate, or are there other fees? If you go get a new line, that's a lower rate, but it costs you a termination or prepayment penalty to exit your current loan. Are you saving any money? So I think you kind of have to look at all the different fees that you have in your agreements, compare apples to apples, go get informed and educated and talk to different lenders, talk to other business owners, see what they're doing. And then you can go ask and try to negotiate your rate. I think you'll just have more information to do that successfully.
Well, that makes sense. Anyone want to add anything to that?
One of the things, Jen hit the nail on the head. I guess one of the things that's going through my head as the discussion was going on is the best thing you can do is have another lender in your pocket. They have the same amount of being being a lender for many years, when somebody's asking you for something and they have no other alternative, you're not exactly motivated to make a change. But they usually come in with something that they've negotiated with somebody else. So I think that small businesses, need to constantly being aware of what is going on in the marketplace, not what the brochures say, but what's really going on in the marketplace, because they'll go in and try to negotiate their loan and not have any other alternative. Good point, Jim.
Well, that sounds like you gave away the secret sauce there, Milton. I that to be out and about in the general public. But all right, so now say the business owner is stuck in a high interest loan and he can't really negotiate a better one. What can he possibly do? Is there a way that you can actually get out of a high interest loan? Do you negotiate with the lender, or do you try to find another lender to buy out your existing loan? Jen?
I would say all of those things. You need to go get educated and see what's out there. And I know it sounds like a hard task, but you just have to go talk to a couple banks, see what other financing options are out there other than banks, maybe. But yes, either negotiate, get a lower rate, find another lender, or we've seen people consolidating their loans under one lender because it just makes things easier than having to deal with different things, and ultimately will save them money in the long run. I don't really have anything else right now. It's like the main thing. So you only have so many options.
There is, yeah. As far as a buyout of the loan, that's not going to be of any benefit, because if some kind of a fund is going to buy out the loan, they're going to buy it out at a discount. They're not going to pass along that discount to the borrower. Like Jen said, sometimes you may just have to stick with it or refinance out of it, and depending on what the exit fees are. It could be significant if it was a fixed rate loan. It could be a market make whole, which means you really can't prepay it. But I guess you just have to shop or figure out a way to try to pass along the cost.
Yeah, and the other thing that since that business owner then would be looking at their financials is just looking at every area of their business. I mean, we don't like to make changes, especially when it comes to employees or different things that we go to or offer. But I think just digging in to all those other expenses that we have, because that can make a difference, and all the little things that you can change can add up. So it might not seem like a lot, but it can add up over time if you change one vendor out for another, or negotiate with all your vendors. Go back to the ones you've had for years and negotiate, because I think that's just kind of what's expected right now with everything that's going on. And it's not just about today. It's kind of, rates are going to continue to go up. So they say, who knows, right? But if they do, then what does that look like if another % gets added on to their interest this year? Now, what does that look like in the business, and can they withstand that? What else are they going to have to change? So it's not just understanding kind of what the past is, but where they're going, and trying to figure out what they can do today that would make that easier. And maybe that means figuring out new contracts with their clients to pass along other expenses that they haven't been able to pass along before, because making those changes on your existing contracts takes such a long time. So what can you do today that will impact you 6 months from now? It's kind of where I'd go with that. Okay.
Well, thank you very much. I think we just about covered every question. If anyone wants to add anything, then now would be a good time. But thanks to everyone that attended today. And our panelists are Antonio Estrada, Jen Merritt, Milton Iskra, and Micah Adams, and our guests. We hope you found our discussion about interest rates very useful and informative, and we'd love to hear your thoughts. So please fill out our post-event survey, which will be emailed to you very shortly, just right after the webinar. And thank you again to our sponsors who made this event possible, and we appreciate the support from Channel Vision Magazine, from RWS Remote Work Solutions, from the Funding University, and of course, ThermoCredit. If you would like to listen to the recording of today's event, it'll be posted on the ThermoCredit and Funding University and Funding Strategies websites within a week. So this webinar is part of a free series of talks that were hosted by the Funding Strategies Conference. So be sure to visit www.fundingstrategies.net to watch our past conversations as well as this one. And thank you for joining this conversation. Thank you very much.
Thank you, Paul.